welcome to Ion Financial. This is where we forge stronger portfolios by cutting right through all the market weakness. Today, we're putting a true American icon under the microscope, running a full-blown stress test on Cracker Barrel. You know, for decades, this company has been a symbol of that home-style comfort, right? That reliable spot on pretty much any American highway. But lately, well, the market's been treating it like a condemned building about to be bulldozed. So the question we have to answer is pretty simple. Is the company's framework still solid? Is this a deep value build just waiting for a smart renovation? Or are we staring at a foundation that is so cracked, the whole thing's about to come crashing down? Let's get to work.
Okay, so here's the blueprint for how we're going to break this down. First, we're going to survey the damage. We'll take a hard look at just how much pain investors have been feeling. Then, we're going to drill down into the two massive pillars of the bear case: a really brutal public attack from a major shareholder and the company's own, frankly, disastrous financial reports. After that, we'll pivot to the bull case, because there's been a surprising rally here that has some people seeing an opportunity in all this rubble. And finally, we're going to weigh all the evidence and give you our verdict. Is this a value trap waiting to spring, or a real deal turnaround story?
So before we really get into the guts of the company, let's just set the stage here. What we're talking about isn't some minor dip. This is extreme volatility. I mean, this is the kind of stock chart that gives long-term investors actual nightmares. The speed of this drop has been, well, it's been staggering. And it's left a ton of people wondering if this is the end of the road for a brand that was once so great. The pain for shareholders has been real, and the market sentiment has been nothing short of brutal.
Just look at this number, $24.85. That's the bedrock bottom the stock cratered to over the last year. Let's be crystal clear about this. For a company of this size, with this history, a number like that isn't just a low point. No, it's a signal of a catastrophic failure in investor confidence. It's the market literally screaming that it believes the entire business is fundamentally broken. This is the price of total capitulation.
But see, that's what makes this next number so jarring. The 52-week high was over $70. So what in the world is going on here? How does a company that was trading at 71, almost $72 a share, see its value get sliced by more than half, hitting a low below 25? I mean, this isn't some fly-by-night tech startup burning through venture capital. This is Cracker Barrel. It's supposed to be stable, dependable. A collapse of this magnitude, it just tells you something is deeply, deeply wrong with the core structure of the business.
That is exactly right. We're standing at a crossroads, and this is the central question for this whole breakdown. Are we looking at a classic value trap? You know, a stock that looks cheap for a very good reason, just sitting there waiting to suck in your capital and then fall even further as the business rots from the inside out? Or is this a deep value build? A solid, iconic brand that's been unfairly punished by a panicky market, offering a once-in-a-generation buy-in opportunity for investors who are willing to do the heavy lifting and look past all the surface-level damage. One path leads to financial ruin, the other to some serious returns. Our job is to figure out which one it is.
Okay, let's start building this out. We're going to start with the bear case, and its first pillar isn't buried in some dusty financial statement. No, this is a full-frontal public assault from a major long-term shareholder, the activist investor Sardar Biglari. And let me tell you, this isn't just some disgruntled noise. This is a calculated, detailed takedown of the company's leadership and its strategy, and it is absolutely scathing.
Biglari does not mince words. He comes right out of the gate swinging with this haymaker. I mean, just listen to that phrase. Destroyed over $1 billion in shareholder value. He's not just saying the stock went down. He's using the word destroyed.
Destroyed. Yeah, that's a heavy word. That's not just talking about market fluctuations. That is a direct accusation.
That's precisely what it is. It's an accusation of active value destruction. He's laying the blame squarely at the feet of the CEO and the board for what he clearly sees as total incompetence. That billion-dollar figure, it isn't just a number, it's a full-blown indictment.
And then he hits them again with this one, a roulette wheel of excuses. So he's claiming that management is blaming everything but themselves. Gas prices, the weather, the pandemic, you name it. So you have to ask, is this hype or is it real? Is this a management team that's actually taking accountability for its failures, or are they just masters of deflecting blame? Because when your ship is sinking, you need a captain who owns the problem. This quote right here suggests they're doing the exact opposite.
And for any serious investor, that's a massive red flag. Accountability always starts at the top. This quote alleges there isn't any.
Lead analyst,
And this just puts the severity of the situation into perfect, brutal context. Biglari draws a direct line, a straight comparison to the absolute depths of the Great Recession back in 2009.
Just think about that for a second. We've had over a decade and a half of economic expansion, raging bull markets, record consumer spending, and yet this company's stock is priced as if the entire global financial system is about to implode again. That is not just a bad year, that's going backwards in time.
It's a full-scale regression. It has wiped out more than 15 years of shareholder progress, just gone. So who is this guy, Sardar Biglari? I mean, is he just some hit-and-run activist trying to make a quick buck by shorting the stock and trashing the company in public?
And that is the critical question, right? But the answer is a hard no, not at all. The source material is very clear on this. He has been invested in this company for over 14 years. This is not some fly-by-night critic. This is a long-term owner who is watching what he believes is the systematic dismantling of his own investment. His long history with the company, it just gives his arguments a weight and a credibility that you simply cannot dismiss. He's seen the good times, he's seen the bad times, and now he is sounding the loudest alarm bell he possibly can.
And if his words weren't enough, Biglari delivers the knockout punch with this simple, brutal table. Look at this. Over the last 5 years, his own publicly traded company, Biglari Holdings, is up 283%. In that very same period, Cracker Barrel is down 70%.
Wow. You just can't argue with those numbers. That is a brutal comparison. He's not just talking the talk, he's showing his own results.
Exactly. He's not just criticizing from the cheap seats, he's pointing to his own track record as proof that he knows how to build value, while at the same time accusing Cracker Barrel's board of only knowing how to destroy it. That contrast, it's just impossible to ignore.
An activist's letter. That's just words, right? Even if they are very powerful words. But now we get into the hard stuff, the second pillar of the bear case. We are moving past the accusations and we are drilling directly into the company's own financial reports. These are not opinions. These are the cold, hard numbers. And frankly, they paint an even uglier picture. So let's start taking this machine apart, piece by painful piece.
Okay, let's start right at the top line. Total revenue. In the second quarter, it dropped nearly 8% year over year. Put that into context for us. For a company of this size, what does an 8% revenue drop really mean for the actual structure of the business? It means the entire machine is shrinking. In this business, the top line is your absolute lifeblood. A decline this steep shows that the core business is taking in less and less cash. This isn't a small leak we're talking about. This is evidence that the foundation itself is eroding. And it gets worse when you look at the heart of the operation. Same-store sales, that's the key metric for your existing established restaurants, were down over 7%.
So just to be clear, this isn't about them closing a few underperforming stores here and there. This means their core established locations, the ones that are supposed to be rock solid, are bringing in less money.
That's exactly right. Fewer people are walking through the doors of their local Cracker Barrel and opening their wallets. The brand's pull is getting weaker right where it should be the absolute strongest. But this next number, this is the one that should absolutely terrify any investor. Guest traffic, down over 10%, double digits.
Market skeptic? 10%. So 1 out of every 10 customers from last year just vanished. Poof. Where did they go? That is a shocking number.
It's the ultimate vote of no confidence from your customer base. You can play games with pricing, you can mess with the menu mix to try and hide weakness, but you cannot hide from a traffic collapse of this magnitude. This is a massive structural failure. Okay, so revenue's down, traffic is in total free fall, but what about the bottom line? Is it real or is this just hype?
Oh, it's real, all right. It's a catastrophe. GAAP net income was down 94%.
94? Wait, how is that even possible? Did they go from making millions to making like a few $1,000s?
They went from making over $22 million in profit in the same quarter last year to just over $1 million. Profitability has been almost completely vaporized. They are barely keeping the lights on from a profit perspective. The entire financial engine has seized up.
In this chart right here, this is adjusted EBITDA. It's a key measure of a company's operating profitability, and it just brilliantly illustrates the operational decay. A year ago, it stood at a pretty healthy $74.6 million. This year, it collapsed to $38.2 million. It was cut nearly in half. So let me get this straight. Fewer customers are coming in, the ones who do show up are spending less, and the company has basically forgotten how to make a profit from its core operations? To me, that sounds like a complete and total structural failure. The entire structure is groaning under the weight of this operational failure. That, right there, is the bear case.
Okay, hold on, stop. The numbers are a complete disaster. The activist is calling for heads to roll, the stock has been obliterated. You've convinced me, this thing looks like a teardown. So you have to explain this to me. Why in the world did the stock just post a massive single-day rally after reporting these horrible numbers? What are we missing? Is there something the bears are completely overlooking?
And that is the pivot. The stock surged over 8%. And it wasn't because the results were good, we just established they were objectively awful. It was because they were less bad than the absolute worst-case scenario that Wall Street had already priced in. This is the classic beating a low bar rally. Expectations were so incredibly low, so buried in the mud, that by simply stepping over them, the company created a massive shift in sentiment.
And just look at how massive this surprise was. The consensus on Wall Street was that Cracker Barrel would lose 20 cents per share. Instead, they came in and reported a profit of 25 cents per share. That is a 45-cent beat.
So it's not a good result, it's just a less terrible than expected result. Is that really a foundation you can build a recovery on? Or is that just market hype and a bunch of short sellers running for cover?
That's the billion-dollar question, isn't it? For a market that was bracing for bankruptcy-level numbers, just seeing a positive EPS, no matter how small, was enough to trigger a panic buying spree. But your point is the right one. Is there any actual substance behind it?
Well, the bulls will point you to these little green shoots, what management is calling their reinforcement plan. First, they're hammering down on costs, planning 20 to 25 million in annualized savings.
Okay, but can they really cut their way to prosperity? Or is this just trimming the fat while the actual muscle of the business, the guest experience, just waste away?
It's a fair question. But then look at the loyalty program. Over 11 million members. And the company says it's driving 40% of their tracked sales. That is not insignificant. It shows they have a dedicated core customer base that they can talk to directly. And then there are the guest metrics. Their Google star rating is at 4.28, which is the highest it's been in years.
So the few customers who are still showing up are happier. Is that really enough to bring back the 10% who already left? That seems like a pretty big leap of faith to me.
It is a leap, but the bulls will argue it's a start. If you fix the in-store experience, the traffic will follow. And lastly, there's an internal metric. Management turnover improved by 10%. They're stabilizing the teams running the stores. So there are signs that a turnaround plan is actually in motion. The real question is whether it's just too little, too late.
So that brings us to the final phase of our analysis. It is time for the verdict. We've seen the demolition crew's blueprint from the bears, and they've highlighted every single crack and stress fracture. And we've seen the architect's proposal from the bulls, pointing to signs of stabilization and a plan for reinforcement. Now we have to weigh the evidence from both sides and decide if this structure is even worth saving.
All right, let's lay out the blueprint side by side. The bear case in this left column, it's just overwhelming. You've got a respected long-term activist, a co-founder, and major funds all screaming that over $1 billion in value has been incinerated. The core metrics, revenue, traffic, profit, are in an uncontrolled nosedive. The stock price is literally at Great Recession levels. To me, this looks like a building that's already been condemned. I get the skepticism, I really do, but you can't just ignore the column on the right. The company just blew past Wall Street's dismal expectations, and that caused a huge shift in sentiment. They have a massive loyalty program that proves a core audience still exists. They're cutting costs aggressively, and there is tangible evidence that the customers who are still coming are happier than they've been in years. The bulls argue this isn't a teardown. It's a fixer-upper with good bones. The foundation is cracked, yes, but the brand itself still has value, and the new renovation plan, while definitely risky, could actually work. It's a classic battle between grim reality and hopeful potential.
So what's our final verdict here at Iron Financial? Look, the deterioration in the fundamentals is severe, and that 10% traffic decline is a 5-alarm fire. The bear case, based purely on the numbers, is nearly undeniable. This is a structure under extreme duress. However, the market's reaction to the less bad news shows you just how much pessimism is already baked into this price. At these levels, you don't need a grand slam turnaround. You just need stabilization. The company has a plan, and there are early, albeit very tiny, signs it might be gaining some traction. So our verdict is this. Cracker Barrel is the absolute definition of a high-risk, high-reward special situation. For the passive investor, the one who just buys and hopes for the best, this is a value trap. The foundation is way too damaged for that strategy. Stay away. But for the speculative, active investor who understands the risks, who's going to watch every quarterly report like a hawk, and who is willing to do the heavy lifting, it could be a deep value build. The margin for error here is zero. If management fails to stop the traffic bleed, this stock is going much, much lower. But if they can stabilize the business, the upside from these depressed levels is significant. So the ultimate question we're going to leave you with is this. With the foundation this cracked, are you the kind of investor who sees a teardown, or are you the kind of builder who sees a fixer-upper worth the risk? That's what you have to decide.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.